Welcome to the deep dive. You send us the sources, we extract the signal from the noise, giving you a fast track to understanding what really matters.
That's the idea.
So today we're digging into a recent report. It's from mapsignals.com titled Volatility Crash 4/24/2025 by Lucas Downey.
Right.
We've got their market analysis right here, and our mission really is to figure out what it tells us about the stock market right now and maybe where it's heading. So the big question, I think, that we're tackling for you is this. Based on their analysis, looking at market volatility, looking at money flow, what are the key signals investors should be watching?
Well, what immediately jumps out, I think, is how this report tackles some of the negative feelings out there head on.
Okay.
It specifically addresses and challenges what it calls a popular bearish myth, which, interestingly, they also talked about before, something about a death cross formation.
Ah, right. I remember that.
Yeah, and they also mentioned their 15 extreme charts for April 2025, which also, lean towards a more positive view for stocks.
So right from the get-go, it sounds like they might be pushing back against the common wisdom a bit.
Potentially, yeah. It feels like they're setting the stage for a perspective that focuses more on their data rather than just, say, the gloomy headlines.
Okay, let's unpack that. This idea of focusing on data. The report makes a pretty strong case that if you want to understand where the market might go, you really need to track where the money is actually moving. They argue that all the headlines, like these ongoing talks about tariffs, they can be a real distraction.
Right. Noise versus signal.
Exactly. Instead, they say, look, the fundamental drivers are just basic supply and demand for stocks. And the author notes, this comes from his own experience on Wall Street trading desks.
That makes sense. Instead of getting, whipsawed by every news alert, the focus shifts to actual patterns, tangible stuff.
Yeah.
And the report introduces their own chart for the elevated trading volumes chart, or ETV.
ETV.
What's insightful here is how they use it to visualize these periods of liquidation. Those big spikes in trading volume that usually happen when stock prices are falling hard.
So lots of selling.
Right. But the crucial point they make is that when these high-volume sell-offs stop, that's presented as a positive sign.
How so?
Well, it suggests that the really intense selling pressure might just be running out of steam. Like, the absence of more panicked selling could mean that whoever was going to sell in a panic, maybe they already did.
Oh, okay. So it could form a base?
Potentially, yeah. A base for things to stabilize or even recover.
Right. And they connect this directly to the flow of money, don't they? In and out of the market.
They do. They have this chart showing how increased outflows, they highlight them as red bars, how those lined up with dips in the S&P 500.
Right.
They use the SPY ETF as an example from back in early February.
I see. So red bars go up, market goes down.
Generally, yeah, that's the correlation they show. But then, crucially, they point to times when that selling pressure faded away and the market sort of found its footing again. And this leads them to talk about a phase of extreme capitulation that really pushed stock prices down hard.
Capitulation meaning just giving up, throwing in the towel.
Pretty much.
Yeah.
Just waves of selling, nobody wanting to buy.
Yeah.
And they attribute the recent market improvement to this capitulation essentially just vanishing, going away.
Okay, so the panic stopped.
And if we connect this to the bigger picture, the report lays out what they see as 4 distinct stages of market pullbacks.
Oh, interesting. What are they?
Well, first you have the classic sort of greed rush of FOMO, fear of missing out, where everyone's piling in.
Yep, seen that.
Second, you start to see increased outflows that kind of put a lid on how high prices can go. Often marks a peak. Let's call it the peak plateau.
Okay, things top out.
Then comes the shakeout. That's the corrective phase where selling really takes hold. And the report notes that most pullbacks actually end right there.
Most end there. Okay.
But then there's a fourth phase. It's rarer, much more extreme, the panic plunge of capitulation, characterized by, a real lack of buyers, negative news everywhere. It feels like there's just no reason to buy.
Sounds pretty grim.
It does. But now, here's where it gets really interesting. The report argues that a lot of investors really underestimate just how quickly the market can snap back from that scary panic plunge, that capitulation phase, right back into that first phase of renewed inflows, the greed rush.
Really? From panic straight back to FOMO.
That's what their analysis suggests might be the path we're on right now. Think of it like a coiled spring.
Okay.
After being compressed really hard, That's the release of that pressure can lead to a pretty rapid rebound. Renewed inflows coming back in.
So this raises a question about opportunity then.
Exactly. The report frames this period of extreme capitulation not as a time to panic, but actually as a potential prime buying opportunity.
Buying when everyone else is selling.
Right. What they call equity fire sales. They admit, look, it's a bold strategy. It goes against the fear when everything looks bleak.
Definitely bold.
But their data, they argue, is pointing towards the anticipation of those, let's call them true buyers, stepping back in, recognizing those discounted prices.
And this brings us to the title of the report, right? The Volatility Crash signal?
Precisely. They highlight the CDOE Volatility Index, the VIX.
The VIX, yeah, the fear gauge.
That's the one. It measures expected volatility, how much uncertainty investors see ahead. High VIX generally means nervousness.
Right.
And the report points out the VIX recently spiked above 50. That's pretty rare. The last time we saw levels like that was back in 2020.
Wow, okay. So extreme fear territory.
But what's really significant, they say, is how rapidly it declined afterwards. It dropped all the way down to 28.45.
That's a big drop.
Huge drop. And they're interpreting this sharp fall as a major shift in market sentiment, a sign that fear is receding, and receding quickly.
Okay, so the fear gauge crashed. What does that historically mean, according to them?
Well, this is where the historical context gets fascinating. They actually looked back at all the instances since 1990, over 40 times, where the VIX eventually closed below 30 after being elevated.
What happened next?
Their analysis shows pretty consistently positive performance for the S&P 500 in the periods that followed.
Like how positive?
Okay, get this. On average, 3 months later, the S&P was up 5.2%.
Okay.
6 months later, up 9.9%. A year later, up 19.6%.
Yeah.
And 2 years later, up 23.4%.
Wow. Those are pretty solid average gains, 19% after a year.
It's a compelling track record, right?
Yeah.
It suggests that when volatility spikes high and then drops significantly, it can be a good sign for the market ahead.
But wait, you mentioned something earlier. There was an even rarer signal.
Yes. Within this volatility crash idea, they identify something even more specific. They actually call it a bear killer signal.
A bear killer. Okay, sounds dramatic. What is it?
This happens specifically when the VIX closes above that really high level, 50,
right,
and then sharply drops below 30.
Okay, so not just below 30, but from above 50 to below 30?
Exactly, that specific sequence. And according to their research, this only happened twice before.
Only twice since 1990.
During, arguably, the two most dire periods for the market in recent history. The global financial crisis.
GFC, okay.
And the COVID-19 pandemic crash in 2020.
Wow. Okay, so really extreme moments.
Extremely challenging periods. And the key takeaway from this bear killer signal is the performance after those two times it happened.
Let me guess. It was good.
The report emphasizes a 100% positive hit rate for the S&P 500.
100%.
100% positive returns in the 1 month, 3 month, 6 month, 12 month, and 24 months following those two occurrences.
That is quite a statistic. 100%.
Absolutely staggering. What the report suggests is that these extreme spikes in fear, followed by that rapid calming, they often mark a real turning point after major market stress, paving the way for a strong recovery.
So if we bring this all together then, the report's main argument seems pretty clear.
I think so.
They're saying that period of intense selling, the capitulation, it looks like it's ended. Volatility is dropping fast. That fear gauge is coming down.
Right.
And they anticipate a significant flow of capital back into the stock market.
Exactly. And their core advice to you, the listener, is to basically follow the money flows. Look at the data patterns, not just the often distracting headlines.
Makes sense. So focus on supply and demand, watch those volume patterns, and pay attention to these VIX signals.
That's the gist. To quickly recap, this Volatility Crash report really centers on analyzing money flow patterns as a more reliable guide than just news.
Right.
It lays out those 4 phases of pullbacks, highlighting that rare capitulation phase as maybe, just maybe, a buying opportunity.
It's an equity fire sale.
Yeah. And most significantly, it points to this rare volatility crash signal, especially that bear killer variant, VIX, above 50, then below 30, as having historically led to really strong positive returns for the S&P 500.
The report definitely seems to suggest there's a potential window of opportunity opening up, doesn't it? Even hinting that people who are hesitant right now might
miss the boat, as they put it.
As capital starts moving back in.
Which leads us, I think, to a final thought for you to maybe chew on.
Okay.
How might these historical patterns the way markets react to extreme volatility, the way investor behavior shifts, as highlighted in this analysis. How might that offer you some valuable perspective during these kinds of uncertain times?
Good question.
And maybe more importantly, based on this deep dive into these specific market signals and the potential for these dynamics to shift,
Right.
what kind of personal strategies might you want to think about or explore?